PDD Holdings, formerly known as Pinduoduo, is a Chinese online retailer, and it's famous for its shopping app Temu, which offers ultra-low-cost items. Although PDD is domiciled in Ireland, all of the company's long-term assets and most of its revenue is generated from China, and PDD has seen incredible growth. Revenue has grown from just 73 million in 2016 to over 22 billion today. That makes it one of the fastest growing companies on the market. At the current share price, PDD has a market cap of $133 billion. It's got 32 billion of cash and investments on the balance sheet and 200 million of long-term debt, so the enterprise value is 101 billion. The company is also nicely profitable. Net income over the last 12 months was 5.8 billion, which translates to a net income margin of 25%, which is great for an e-commerce company. The company also made 7 billion of adjusted ebitda and an estimated 8.8 billion of free cash flow. So PDD stock is valued at 4.4 times revenue, 23 times earnings and 11 times free cash flow. That seems incredibly cheap because PDD is still growing fast. In the latest earnings report, revenues increased 66% from the year prior and net income was up 47%. That growth is being driven by both domestic and international demand. The company has spent huge amounts of money advertising its Temu shopping app, which is popping up all over the place, and they even bought an ad at this year's Super Bowl. If you assume that Pinduoduo can sustain a 15% revenue growth rate for the next 5 years with a 25% net income margin, revenue in 5 years' time would be 46 billion and net income works out to about 11.6 billion. Apply a 25 times multiple to that and the company would be valued at $290 billion, which works out to an investment return of 17% per year. That is an excellent return, especially when you consider the company is currently growing much faster than 15% per year. However, before we go any further, we need to talk about the risks because PDD has had its fair share of controversy. In 2019, it was targeted by hackers who exploited a loophole and stole tens of millions of won's worth of vouchers. In March, Google removed the Pinduoduo app from the Play Store due to security concerns after it was found to contain malware. And this week, Grizzly Research published a scathing 72-page report on the company. The report claims that the Temu app is the most dangerous malware and spyware package in circulation, which is being used to extract Western users' data to send to China. It also claims that PDD's financials are unreliable and the company hasn't had a CFO since 2018. So, on the surface, PDD looks like a tempting investment opportunity with high growth. But there are simply too many red flags, and a bill is already going through Congress right now that could easily put an end to the Temu app in the US. That would clearly derail PDD's international growth prospects. All that said, I think it would be highly risky to short a company with such strong growth. That's why I'm giving this stock a neutral rating today. But these are my personal opinions, not financial advice, and I've got no position in PDD. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.